Hey everybody, so I want to make it very clear up front within this video that like the whole entire intent of all of this isn't to do anything directly with regards towards the stock market. I'm just utilizing the stock market in this instance as like the ultimate obliteration test for my hypothesis. And my hypothesis in this instance is that within any sort of data set whatsoever, that there's a temporal geometry and a temporal structure that emerges within that data set and that can be measured, acted upon, predicted, etc. From that data set. And then in that instance, I choose the stock market as like the ultimate obliteration test for that, because the stock market is literally built against that, right? Like it's like a job is to make sure that there's no direct pattern that exists that can be manipulated like from day to day to measure that. And then so within that, none of the tests that I'll be doing or experiments that I'll be doing within or showcasing within this will be like directly like trying to predict like stock market prices and things like that. That's not what the direct intent is, right? What the direct tests are. Overall, the direct tests within this particular framework are so it breaks the stock market down into regimes, and then regimes being like how tense the market is. I create I literally create this algorithm where we measure tension, and I'll dive into that. But tension can be measured as like low, medium, and high, and then within that, like if it's the market is in a low tension state, then it's very predictable. Like you know exactly what the market is going to do. If the market is in a high tension state, then it's like complete chaos, right? Like don't bet on it. Like don't bet on anything directly within that. And then unsurprisingly, by looking at a lot of data, the market generally operates in a high tension state. Although when I like examine this and I look at like Bitcoin data, things like that, Bitcoin data is like it's very different from like the stock market data. It's a lot more chaotic, but it has a lot less high tension states overall. And I'll dive into that when I dive into and dive deeper into all of this, right? But so starting off within this, for decades, most people have believed a simple story about financial markets, that it's basically random, that there's no one can really predict anything about it. And at the level of prices, that's mostly true. Day-to-day movement often looks like noise. But what if we've been asking the wrong question? Instead of trying to predict prices, what if we asked, is there a hidden structure in the way that markets evolve through time? Not, can I trade on it? Not, can I beat Wall Street? Just, is the market's behavior governed by an underlying geometry, a structure that exists only when events unfold in real time and disappears when the timeline is scrambled? This is the story of how we tested that idea, what we found, and why it matters far beyond finance. So, why this matters? A physics question hiding in finance. What I'm exploring is simple but radical. What if markets and many real-world systems aren't driven by random jumps, but by a hidden geometry that only exists in time? Not geometry like triangles and circles, geometry like attractors, stable states that fall into basins, regions where behavior is similar, regime shifts, sudden changes in curvature, temporal flow, how the systems move from one state to another. If this geometry exists, you should be able to detect it by measuring how strained or twisted the system feels at each point in time. I want to dive a little bit deeper into this direct concept here, right? Like, so this concept of like attractor basins is very like prominent all throughout, we'll call it like human history, right? And there's different and differing examples, and like people bring it up in different contexts, like different people can be on like the same wavelength, or with like women, like their cycles and can tend to go and modulate, right, like be similar, things like that. And then all different types of examples of kind of this attractor basin type of geometry existing within nature. And then so whole point overall of this is to kind of measure and detect that. Does that actually exist? And then so, and can we exist and measure that within the stock market? And then so if this geometry exists, you should be able to detect it by measuring how strained or twisted system feels. If it doesn't exist, then markets really are just noise. But this isn't about getting rich. This is about whether time has a physical structure that shapes complex systems. And the stock market is simply the most brutal adversarial testbed that we could possibly pick overall for any of this. So if hidden geometry exists there, it likely exists everywhere. And then so a new measurement, market tension. So to explore this, we built a simple idea. Tension is T, with small t, a number that measures how strange, unusual, or unstable the market looks today compared to its past. This isn't volatility, this isn't technical analysis, this isn't sentiment. It's something more fundamental. We look at each day's basic features, the open, the high, the low, the close, and the volume, and we compare today to many past days. We measure how close or how far those past days are, not just in price, but in time. And we compute a ratio that captures how unusual today is. If the market today resembles past calm days, then tension is low. If today resembles chaotic periods or is unlike anything seen before, then tension spikes. And so think of it like this. The market is walking through a landscape. Sometimes the path is smooth, sometimes the terrain tilts sharply. Tension measures the slope under the system's feet. And then so the crucial test within this, real time versus scrambled time. Once we can compute tension, or small t, we can ask a profound question. Is tension's behavior driven by the real sequence of events, or is it just a random function of price levels? And then so to test this, we created two versions of the same exact data set, and then I ran like a whole bunch of a slew of experiments using these two versions of the same data sets. But so within this, we have a real data set and a scrambled data set. And so real data is prices and volumes exactly as they happened from oldest to newest. And a majority of the tests, it's the Apple data set, and it's like 5 years of Apple stock market history, and then some Bitcoin as well. And then in Scrambled, it's same days, same prices, same volumes, but placed in random order. And then so scrambled time means that like 2024 can become before 2020, March may follow December, and the entire structure, temporal structure, collapses. If the market's behavior has no inherent temporal geometry, then real tension and scrambled tension should behave the same. And then if time is a real geometric dimension, then scrambling it should break the patterns, destroy structure, and produce meaningless tension sequences. And that difference will be the evidence. And then so that's what all of these experiments were and designed to measure overall, right? Is this question very specifically. Does real tension differ from scrambled tension in meaningful ways? And I can show you very definitively that the answer is yes. like ecstatically yes. And so the shock, real data has coherent structure, scrambled does not. We ran this test first on Apple with 5 years of daily data. What we saw was that real tension forms waves, ramps, spikes. It has a clear structure. Scrambled tension looks jittery. It looks like noise. The average tension in real data was 3 times higher than in scrambled data, not because prices were higher, but because the true timeline created more curvature. Time mattered, but this was only the start. From numbers to regimes, the market's hidden moods, and this is like the kind of exactly what we're testing within these experiments, right? And so a raw tension number is hard to predict. I mean, like, is the market going to move up or down tomorrow? And I show that in these tests that like it's very hard to predict that, right? Like it's kind of like the market moves like essentially like in a lot of ways orthogonally to the structure, to the geometric structure, but not like exactly orthogonally. So you can't directly measure it. There's chaos within trying to measure whether or not the market is going to move up or down tomorrow based off of events. It just doesn't work that way. And then so we clustered tension values into 3 distinct regimes. And then so think of these as market moods. And then so 1 is regime 0, which is calm, there's low tension. 2 is regime 1, where there's a mildly strained and medium tension. And then 3 is regime 2, where you have highly unusual or turbulent or high tension. And these weren't handpicked, these were what the algorithm discovered. And then we classified both real and scrambled tension sequences into these regimes. But the real test was next, the fundamental question. Can we predict the market's future mood? Not price, just the regime. So using only tension from the past 20 days, we asked a simple question. Can we predict what regime the market will be in 5 days from now? This isn't about predicting price. This is forecasting which mood the market will be in. And then so we used a small neural network, or a GRU. In this instance, I'll give you all the code for that. And then a simple baseline, which is the future regime is the same as today's. And then we tested the same prediction on real data and scrambled data. And then if temporal structure is real, the model should only learn from real data, and it should fail miserably on scrambled data. And then so in our results, our GRU accuracy had like, we got it up to like 90% accuracy within this, right? So essentially within that, what that means is that like this model can tell you very accurately whether or not the what the predictability level of the stock market will be in like this particular instance on Apple 5 days from now is like how that works out. And then so this model significantly outperforms the baseline. Even more interesting, the model confusion matrix shows that the market predominantly falls into regime 2, go figure, right? Which is the high tension attractor. And then so once in this regime, the model predicts with like near perfect accuracy that the market will remain there 5 days ahead. And then so essentially what that means is that like if the model hits this period of instability, like, and it's like day 1, 5 days out, like 99%, it's still going to be lasting for 5 days, and it's going to be within that period, right? It'll be a stable attractor for that overall. And then when we scramble the data, overall accuracy plummets, right? Like GRU accuracy actually falls below baseline accuracy. And then so the model does worse than the dumb rule. Its predictions just basically collapse into nonsense. There's no attractor, no structure, no geometry. Exactly what you'd expect when you tear apart the timeline of a geometric system. And then so this is very specifically and very clearly what I built these tests to measure overall, right? And then Interestingly, the same pattern and the same results happen with the Bitcoin data, but the Bitcoin data is harder to predict overall. Like Bitcoin is a lot more noisier, it's a lot more chaotic. But even then, I'm still like we're getting like 58% accuracy compared to baseline accuracy of 55%. So it's still better than the baseline, even in the volatile system. And then so certain regimes, especially the normal tension ones, are highly persistent. And then once entered, the system tends to stay there. Same pattern as with the stock market, right? And then same pattern with the stock market as well, that when we scramble it, accuracy plummets, and then the model accuracy falls below the baseline. So same collapse into chaos, same destruction of structure. Pattern is universal. Real time is structure. Scrambled time is no structure. Time isn't an index, it's the backbone. And that's kind of the bottom line of my hypothesis overall within this, right? And so what this means is that you can destroy the market by scrambling time. There's a profound takeaway. The market has a hidden structure that only exists because events unfold in a specific temporal order. In real time, tension evolves along a smooth but also chaotic curve. Regimes form attractors, and then the system tends towards certain basins, and then forecasting a future mood becomes possible. And then so this is like what is easy to predict among the chaos of all of the data is the future mood. And then so in scrambled time, structure disappears, attractors vanish, transitions become noise, models fail, and the baseline rule often performs better than the neural network. And so this isn't about trading signals, this is evidence of underlying physics. Markets, like many complex systems, appear to move on a temporal manifold, not on random jumps. And then so one system summary of this that anyone can understand: we discovered that markets follow hidden moods that evolve over time in a very predictable way, but that predictability disappears if you scramble the order of the days. That means that time has real structure, and it isn't just numbers within this. And then, so why that matters and why this matters beyond finance. So if this exists within Apple, Bitcoin, and any other asset, it also exists, because this is like the most obliteration test that we can do within this, right? I run this test because it encompasses and it should hold true for patterns like weather, neural activity, biological rhythms, social systems, CPU load, cryptocurrency mempools, even AI model behavior over tokens. Anywhere that time flows, geometry flows with it. So we've been treating time as a label. Time might actually be the substrate, and that's like the most important thing within this and in these experiments, right? And to break down within these experiments. So how these experiments work overall is that the model doesn't actually learn any sort of labels on this data, right? I very specifically strip the labels. The model is only analyzing temporal geometry. And then so what is temporal geometry? In this instance, temporal geometry is very specifically a modification of the k-nearest neighbors algorithm. So unlike traditional k-nearest neighbors or KNN, which treats data as a static cloud, this approach models data as a streaming manifold where distance is a function of both feature space similarity and time lag. And then essentially how I get that is my typical KFN plus KNN, but then I also add a plus T and plus a temporal element, and then that distance measurement becomes a temporal and causality element that I'm able to train, which becomes the tension element overall, and that's the full equation that you can see here, and then the breakdown of exactly what I do within those different experiments from there. And then I start off trying to predict, like, will this model be able to predict like the pricing tomorrow? And it's like, no, it doesn't work that way, right? Like, it's just the stock market is very like built against that. Like it's just how it works, right? And there's lots of algorithms overall that enforce that. But can I predict the mood of the stock market tomorrow? And like over 90% accuracy, yes. I can predict the mood of the stock market tomorrow. And then the mood will tell you like essentially like whether or not like what the stock market is going to do, right? If the mood of the stock market tomorrow is calm, then like you can predict like whether or not like with very high accuracy whether or not it's going to go up or down. If the stock market is in a volatile state, you can coin flip. Like it doesn't matter what the actual data is that is coming out in the market that day. Like the market is just going to coin flip it basically, and like the market operates that way a lot of the time, more often than not. And that's just kind of how all of these experiments break down and what they showcase. Lots of pretty graphs, right? And lots of cool tests within this, and lots of cool data within this overall. They get more complex overall, and then the end result is, like I mentioned, like that full GRU model, right? So it starts getting like where you can actually these are actual usable models for predicting stock market analysis, and then the last one is for Bitcoin plus stock market, and you can adjust it. And it gives you these are full-on benchmarks that you would see everywhere, and you can see with the stock market data, especially if it's and especially if it's in regime 2, it's the model because it's very high accuracy with its prediction rates, right? And that's beating out the baseline accuracy within the baseline scores for accuracy within that. And then you can see that when we do scrambling and we scramble it really messes up those numbers overall. And then so same thing here with the this is with the Bitcoin data, and then so this is the full model overall, right? And then so this is the full geometric GRU model, and then this gives you outputs for everything that you would want and to look for both Apple there, and then here's the Bitcoin analysis, as well as the confusion matrix. The confusion matrix is matrices are super cool to look at as well. You could do, and if you wanted to try to make these more experimental in different ways, whatever, you could take these in a lot of areas in those levels, but I'll leave that up to you. I'll leave a link to the Substack article here where you can access this notebook. Do whatever you like with this code. And if that's the type of content, please like and subscribe. Thank you much.